Picture yourself at your trading platform, feeling your heartbeat race as you consider clicking the buy button. The pressure is on, and your mind is full of possibilities. Sometimes uncertainty isn't about having a bad strategy. It can come from overlooking a few simple rules that could help you make clear, confident decisions. Welcome to MOOLAH IQ, where we make personal finance, investing, and trading simple. If you're new to trading or still feel unsure after some experience, this video is here to help you find clarity. We'll walk through key principles that build real confidence, not just excitement. We'll start with protecting your capital, move on to risk management, talk about journaling, and finish with the importance of consistency. These rules help you think clearly and manage your emotions. First, let's see why basic rules are so important and how they prepare you for success. Let's start by understanding why foundational rules matter. Trading is often taught as a technical skill. In reality, it's a decision-making skill under pressure. The rules we'll talk about today won't predict the market, but they will protect you as you learn how markets work. With this in mind, let's move on to the first important rule. Rule 1. Your first job is to protect capital. The most important rule in trading is also the least exciting. Your job is not to make money first. Remember, your main goal is to avoid big losses and stay in the game longer. This is the base for any future success. To make this practical, try not to lose more than 5% of your capital in a month. This limit acts as a safety net, turning careful planning into daily habits. For example, if you have $10,000 in your account, 5% is $500. If your losses get close to $500 in a month, it's time to review your strategy and take steps to lower your risk. You might reduce your trade size or adjust your stop-loss levels. This approach helps protect your money and gives you more time to learn. Many beginners see trading as a test of intelligence or speed. This brings pressure and risk-taking. Think of learning to swim. You don't jump into deep water immediately. You learn in shallow water where mistakes don't put you in danger. Trading works the same way. Small losses keep you calm. Large losses trigger survival mode and halt learning. Protecting capital isn't fear. It's about feeling secure as you trade. Once your capital is safe, the next step is to look at risk and how to manage it well. Rule 2. Define risk before you enter. Professionals define risk before they click the button. Beginners set risk based on emotion after seeing price changes. Let's ground this in real numbers. The math of risk. If you have a $5,000 account, risking 1% per trade means your maximum loss is $50. That means you could be wrong 20 times in a row and still have 80% of your capital. Psychology behind this: when risk is small and predefined, your brain stays in problem-solving mode. When risk is unclear, your brain switches to threat mode. It's like budgeting. You don't walk into a store and hope the total comes out right. You decide your limit first. Key takeaway: defining your risk in advance gives you emotional stability, improves judgment, and keeps your trading consistently disciplined. Make this step part of your process before every trade. Rule 3. Always know where you're wrong. Every trade must have a point where the idea is invalid. That point isn't personal, it's logical. A stop-loss isn't about being right or wrong. It's about recognizing when information has changed. Think of driving with GPS. If a road is closed, you don't argue with the map. You reroute. Trading works the same way. Set your exit point in your trading platform before you enter a trade. This way, if things change, you already have a plan to adjust. On most platforms, you can set a stop-loss by choosing your trade and entering the stop-loss price, usually found near the order entry. Just pick the price where you'll exit to avoid bigger losses. The hardest part is accepting uncertainty. Many beginners hold losing trades because exiting feels like failure. But in trading, staying wrong is more damaging than being wrong. Every trade needs a clear exit plan. With this safeguard in place, you're ready to focus on how you measure your progress and success in trading. Rule 4. Measure success by execution, not outcomes. One of the biggest psychological traps in trading is outcome bias. Outcome bias means judging decisions by results rather than by the process used. A poker player can make the right move and still lose the hand. that doesn't make the decision bad. Trading works the same way. Professionals ask, did I follow my rules? Did I control risk? Was the setup valid? Measuring by execution makes improvement visible. Judging by profits triggers emotion. Success in trading comes from following your process, not just making a profit. Focusing on your actions lowers stress and helps you improve steadily. This way of thinking also helps you avoid overtrading, which is a common problem for beginners. Next, let's talk about how often you should trade. Rule 5. Trade less than you want to, the 3-second rule. Overtrading is rarely about strategy. This is often about emotion, boredom, impatience, the need to feel productive. Think about how you check your phone when you're bored. You're not really looking for anything, just passing the time. Trading without a clear signal is similar. Use the 3-second rule. Before you click buy or sell, ask 1. Is this trade in my written plan? 2. Is my stop loss already set? 3. Am I trading because of a signal or because I feel restless? This pause interrupts impulse and brings intention back. Trade with purpose, not on impulse. If you pause and act with care, you'll usually trade less, which is often the better choice. Now, let's see why a simple strategy can help you get even better results. If trading ever feels rushed, stressful, or emotionally draining, it is not a motivation problem. It is a clarity problem. In such moments, taking a short break to clear your mind can be beneficial. Step away from the screen, take a few deep breaths, and revisit your written plan. This provides an opportunity to regain perspective and reassurance before making any decisions. Clarity starts with structure. Rule 6. Keep your strategy simple. Complex strategies often create false confidence. Adding indicators increases confusion, not certainty. Picture a chart crowded with bright, tangled indicators versus the calm look of a simple 2-color chart. Psychology behind simplicity. The brain makes better decisions when the number of variables is limited. Simpler systems reduce hesitation and regret. Think of cooking. A recipe with 5 ingredients is easier to repeat consistently than one with 20. Being consistent and keeping things simple helps you succeed early on. Practice building a clear, repeatable system. Once you have a simple plan, it's also important to change how you think about losses. Let's talk about how losses are part of trading. Rule 7. Losses are a cost of doing business. Losses are not mistakes. They're operating expenses. A restaurant owner doesn't close their business because milk spoils. It's expected. Trading losses are expected, just like spoiled milk in a restaurant. The psychological danger comes when losses feel personal. That's when traders take revenge, double down, or abandon rules. Losses are just part of doing business, not a sign of failure. Keep your trade sizes small enough so losses are never too hard to handle. If a position feels threatening, it is usually because the size is too large. To further safeguard your process, always rely on a clear written plan before trading. Rule 8. Never trade without a written plan. Rising emotions make memory unreliable. A written plan acts as an external decision maker. Pilots use checklists not because they lack skill, but because stress distorts judgment. To help you get started quickly, consider using this microplan template. 1. Define the instruments or markets you are comfortable trading and why they suit your strategy. 2. Set clear entry signals with precise criteria for when you will initiate a trade. 3. Decide on exit strategies, including stop-loss levels and profit-taking points to mitigate risks. 4. Determine the amount you are willing to risk on each trade. Here's a sample filled-in microplan for a common trade. Suppose you are trading in the Forex market. 1. You decide to trade EU after USD because it suits your strategy of high liquidity and lower volatility during European market hours. 2. Your entry signal is when the 20-day moving average crosses above the 50-day moving average and the RSI is below 70. 3. You set your stop loss 20 pips below your entry point and your target profit at 40 pips above your entry price. 4. You decide to risk 1% of your $10,000 account on this trade, meaning you are willing to risk $100. This structured plan reduces uncertainty and provides clarity in decision-making. 1. Define the instruments or markets you are comfortable trading and why they suit your strategy. 2. Set clear entry signals with precise criteria for when you will initiate a trade. 3. Decide on exit strategies, including stop-loss levels and profit-taking points, to mitigate risks. This simple framework reduces planning friction, making it easier for beginners to take decisive action. A written plan keeps you from making emotional decisions. This structure helps you trade more consistently and with less stress. Once you have a plan, honest journaling is your next tool for getting better. Let's see why keeping a trading journal matters. Rule 9. Journal every trade honestly. A journal isn't for perfection. It's for insight and growth. Athletes watch game tape. Musicians listen to recordings. Traders review journals. Without feedback, you unknowingly repeat mistakes. A journal reveals emotional patterns, risk mistakes, strategy weaknesses. Writing down your trades honestly helps you see what works, fix mistakes, and improve faster. Here's a simple example of a trade journal entry. Date: 1/8/2026. Asset: EUR/USD. Entry price: 1.2000. Exit price: 1.2100. Stop loss: 1.1950. Take profit: 1.2150. Reason for entry: 20-day MA crossed above the 50-day MA. Entry based on valid signal. Review stop-loss placement for closer alignment with market volatility. This format captures the key details and helps you reflect to improve your strategy. Rule 10. Consistency beats intensity. Trading rewards steadiness, not intensity. Going to the gym once a month for 3 hours doesn't beat going 3 times a week for 30 minutes each. Consistency helps you trust yourself and your trading process. For example, a steady 1% gain each week adds up to about 67% in a year. This shows how regular effort leads to real results. Steady practice and repeating small advantages compound to greater trading growth over time. Self-reflection. What is one specific trading result you want to see in your life this week? Why does this goal matter to you personally, aside from making money? If this video helped you think more clearly, please like it. Leave a comment with one rule you're committing to, and if you want more content on trading, you're welcome to subscribe. Trading doesn't reward excitement or intensity. It rewards clarity and consistency. You don't have to change everything at once. Just take one small, thoughtful step today. Remember, simple rules work best. As we started with the idea that simple rules give us confidence, let's end with that same thought. This is MOOLAH IQ, helping you increase your financial IQ, one wise decision at a time.